So let's now have a look at some examples of strategies we use every day to trade the markets and how you can get to grips with them, learn when to apply them and figure out the ones that fit you best. Now, as with the entire principle behind this training, our goal is not to spoon feed you a method that will work all the time that you can just trade blindly, because as much as that would be lovely and simple, that is not how the markets work. What will make you a skilled trader is knowing when to apply a certain strategy and when to leave it alone, based on the prevailing sentiment and market conditions, and this can only be developed through practice and experience trading the markets in real time. It's very important to set your expectations correctly here because your trading skills will sharpen over time. So don't expect to be taking this course in the first week and managing £1 million the month after. It simply doesn't work like this, and these skills develop over months and years rather than days and weeks. However, by learning successful strategies that our team already employs, you will again shorten that learning curve substantially and reduce your development to just the time it takes to practice what you've been shown in the real markets. Now, it's important to understand that your strategy is not the be-all and end-all for your trading. The absolute best way for you to learn the process of finding trades and identifying the best currencies will be trading the upcoming session will be by following along in those daily analysis briefings, where you'll be listening to either myself or one of our other professional traders as they themselves analyse the markets and, of course, identify good setups. You will see the process for selecting currencies play out day after day, and you'll really understand how to do this for yourself within only a few months of following these sessions. You will see elements of the strategies we're about to cover used regularly, but you'll probably not see us stick to any one strategy rigidly because, as you've already learned, this is just not how the markets work. If it was as easy as blindly following a mechanical strategy, then 95% of traders would make a profit instead of a loss. So let's begin with the first strategy, and the best way to do this will be to just go through them one by one now, and remember all these strategies are employed directly after the analysis phase. So don't think that just because you have a system you can cut out any of the 4 phases, because they are relevant no matter how you execute your trades and what you base your positions on. The first strategy that we'll look at is of scalping the fundamental levels. Key price levels that are basically any price that can be considered important or more likely to generate a market reaction. Basically, they are price levels that the market is more likely to be watching and trading from than any other price. The reason that certain price levels are more important than others vary, and we will again look at some of the most common ones right now. The absolute best levels are those where there are significant orders placed. For example, if a large bank is reporting that a lot of their clients seem to be placing sell orders at a specific price, then there's a very good chance of the price reacting off that level should there be a rally into it. The opposite of true is if there are some buy orders below where the current price is, and so on. If everyone else is selling from a price, then you want to be trying to sell from the same price too. And if everyone is buying, then you want to be buying too. The news feeds that we use have a filter especially designed to highlight all of the bank order levels that are available across a variety of pairs. As we looked at earlier on, any price level that has orders at it will be significant in the session should the price get there. This does not mean that the price will react from the levels every single time. For example, if something happens in the market and traders suddenly no longer wish to be selling the pair, then they can very easily pull their orders and the price level becomes useless. So these type of levels are only powerful as long as nothing has changed in the market sentiment. Now, the basic concept of scalping these levels is that they give you a very precise price to trade from, which means that you're either right or wrong, and you know very quickly either way. If the price breaks the level and trades 50 pips away from it straight away, then you are clearly wrong in your analysis because we're looking for an instant bounce as the orders there get triggered. What this means is that we can use a much smaller stop loss than normal, which in turn allows the use of some leverage that you deem appropriate. Our advice is that you never use leverage no matter how you trade. But for those of you that do, then pinpointing your entries is going to be imperative to your long-term success. And this type of strategy is perfect for this. If you're not trading leverage, then it also allows you to take multiple trades each day without the risk of having huge losses, because if each trade is only losing 20 or 30 pips or less, then you can afford to be taking the chance, because even if it takes 10 trades and lose them all, you'll only be risking 2% of your account overall, unleveraged of course. If you have analysed the setups correctly, then it's likely you'll be winning a high percentage of your trades, which mean consistent profits over time. Now, a key level does not just have to be fundamental orders from banks or brokers. It can be anything that gives the market a reason to trade from that specific price. And the more reasons you have, the stronger the level. Lots of things at the same price, as of course, as we've earlier looked at, is called a confluence. So for example, if you see a really good level of resistance where the price has already reacted from recently, and you know that there are some strong bank orders there along with a pivot point, then this is much stronger than bank order levels on their own. So technicals can play a big part of selecting your levels, and you can feel free to identify the levels with the best confluences as your entry points. Now, in the beginning, you will likely lose money, whatever strategy you trade, for two reasons. First, you failed to prepare fully or have been lazy with your analysis phase. Or the second one is that you've not yet perfected your trade management, which is simply a case, as we've mentioned many times, of practice over time. After everything we've looked at, I'm going to assume that you're not being lazy with your analysis, and so we will focus on the trade management aspect next. So let's walk through an example of how you would select a decent price level and then enter, manage the trade, and then exit. Okay, so here we have an example of a trade that you could scalp. So what we're going to do is we've marked the charts up. The trade is already played out, so it makes it easier to visualize. But basically, this is the principle. So we've got the pair here, and we're going to assume, of course, that in the hypothetical scenario that we are looking to sell this pair for the session. We've got correct sentiment, everything's lining up. We want to be selling this pair. The next thing we want to do, of course, is go to our charts here and identify a good level. Now, as you remember, the key to scalping is, of course, finding those confluences and those levels, okay? So, if we are looking to sell, and particularly if we're looking to scalp, we want to basically make sure we find a pinpoint entry where the price is going to virtually react from straight away. So, let's have a look at this chart here. So, at the beginning of the session, what we're looking at, well, we can see the beginning of the the selling zone is the daily central pivot here. That's the start of the selling zone. What else have we got? If we draw a Fibonacci from the high of yesterday down to there, you can see it overlaps with the 38.2. So you've got the daily central pivot overlapping with the 38.2 perfectly, which basically is a nice solid confluence of reasons to sell from that level. Now you'll also notice the price there is around the 129.50 level, which of course is in between the double zero. So again, it's a like a psychological level as well. So we've got a nice confluence of levels. Now, for scalping, that's your entry. So you don't want to do anything. You want to watch it, and then as the price makes its way up to here, you basically enter the trade. Now, remember, this is a scalp trade, so what are we looking for in terms of risk? Well, you can see here the average daily range is around about 100 pips. So that means we want to use roughly 25 pips stop, 25% of the daily range. So if we measure that, that's about where this red line is here. So if we enter here, we'll be putting our stop loss just about here, nice and small, and then we'll be managing the trade closely. So you can see this is our entry level here. Every time the trade goes 5 or 10 pips in our favour, we then reduce our risk. So for example, you can see the price fell down here 10 pips. So we remove 10 pips, and then the price had a little rally back up to the entry, and then it came and broke and went to around 20 pips, 25 pips in fact, in which case our stop would now be moved to break even. Now we're at break even. First task is to get the risk out as quickly as possible. So every time the price goes 5 or 10 pips in your favour, you reduce the stop loss by 5 or 10 pips. Then, once you get the situation to break even, your next goal is to take profits before the price turns. Remember, this is a scalp. Price action will turn, as you can see in this example. It will turn. You need to get out at the best possible price. So where is that? Well, we're looking for levels where the market has already bought it back from previously. And you can see the low here is a perfect area. Price comes down into these lows. As soon as you get these candles starting to show some little signs of support, because this is where the price has previously been bought from, you just get out, you take your pips. On this one, you'd have about 20 or 30 pips in the bank, maybe 25 pips. So you're only going to get profits relative to what you're risking, but that's what scalping is. So if you're risking 1% on your trade, you're probably going to make around 1% on your profit, but basically that's how you do it. So your first goal with scalping is to get your risk out as quickly as possible, and to do that, every time it moves 5 or 10 pips in your favour, you reduce your risk by 5 or 10 pips. As soon as you got to break even, you forget that, and now you focus on where am I going to take profits, and you want to be able to get the best type of profit possible. This is again going to take practice. It's not going to be, you're not just going to nail these every time, hit the winners all the time. You're going to maybe take your profits too early, you're going to probably wait too long, but over time you'll see that these kind of areas are the best levels, and that managing your risk like that gives your trade just enough room to breathe while not getting stopped out and whipped out with the volatility. But if it does go against you, you're not going to lose too many pips. So that's the general way that you scalp. So you have your sentiment, you know which way you're trading the pair, and then you look for a confluence or a price level on the short-term time frames which you can trade from. And the key is then managing your risk aggressively to get your risk out as fast as you can, and then look for a nice target, which again is relative to how much you're risking, so that you can then make your profits. Now, again, you can move your stop to break even and just hold this position, and in this example you'd have got stopped out, but sometimes the trades will run and you'll make a few hundred pips. And in those cases, if you're using leverage, that's when you can really see some massive gains on your account. But it takes discipline, it takes patience. It's not, for example, it's not a way I like to trade, but we do have traders here, particularly trading their own accounts, that do trade in this way. But that's the nutshell of how you scalp. If you did want to use leverage, that's how you have to manage your trades and get your risk out fast and protect yourself from any volatility in the market. So as you can see, the process for selecting such a trade is fairly simple, and when you start using the tools we've looked at in conjunction with one another, there are usually several opportunities to scalp these type of levels every day, whatever you decide to include in your confluence. Most traders working at professional firms such as ours are brought through to become day traders because, as we've already looked at, this is a good combination of regular trading activity while keeping the risks limited. The news feeds are of course the main source of all our information and trading opportunities, and without these feeds you would in effect be trading blind. So one of the most common trading setups we'll look at next is those that are derived directly from the news feeds each day. Day trading the news feed is actually fairly simple and one of the best ways to find high quality trading setups. This is not as precise as trading key levels because the main thing behind trade success is not the place where you enter, but rather the reasons for the move and the timing of your entry. So let's just walk through a typical day of scanning the news feeds to get an idea of the type of things we're looking for. Your analysis of course starts on an hour, or maybe 2, before the London session opens, as you're reading the overnight or pre-session news, to look for things that traders getting into their desks are likely to react to. This does take practice, but basically the golden rule of sentiment is that the more something is known, the less of an impact it will have on the market. So if you're looking for surprises or changes in the tone from central banks, or even breaking news that could change the market's view on a specific currency, or how the bank may approach its interest rate adjustments in the near future, if you see something of note, then the next step is to plan your trade. At this point, you can either jump straight in the current market price, or try and wait for a price to pull back to a nearby level of support or resistance. The risk of jumping in is that the price might pull back first and you'll be sitting in drawdown and need a bigger stop loss to cater for this. The risk of waiting for a pullback is that you could miss the move, simply because there is a clear reason to trade it from the open, so any pullbacks could be less likely. So, how do you decide what to do in this scenario? Well, the best way is simply practice and experience. Remember, you are now past the training stage as soon as you start placing trades on your practice account. So you're at the skill building stage. One of the best ways to build your skills is of course to practice, practice, practice. One tip to help you at the start is to split your position into 2 pieces and enter one at market while entering the other at your proposed level of support or resistance. This gives you 2 bites at the cherry while only risking a single position. This, of course, is only a starting technique to assist you in the early months, because after a while, you'll start to build a natural confidence of when to enter and where to place your orders. So this will then give you a nice day trade that you can hold as the session opens and plays out. Obviously, you will have a stop loss in place and a target in mind, and we have prepared some trade examples from my own personal training and trading to help you understand the process for placing these orders. Generally, you want your stops around 25% to 50% of the average range away from your entry, and your target should be based on where the market has already reacted from in recent sessions. So don't try and day trade past an established high or low, because generally this will result in losses. The best technique is to take your trade off just before the top or bottom of these levels. But what happens if you do not see a trade at the open? Well, you keep watching the feed and now switch to a mode where you're looking for surprises or comments that the markets are not expecting and review as fresh news or a fresh reason to trade. These come through as headlines and are no set standard words or phrases we can list, but the golden rule of sentiment is your key. Generally, it will be either an announcement from a central banker or a comment from some sort from someone related. For example, look for things like a dove commenting that rates should probably be hiked soon, or a hawk stating that they feel there is a strong case for rate cuts. Again, this is something you will get better at over time, so we suggest that you make this one of your staple strategies and start practicing it straight away. But by keeping your eye on the feeds for these type of comments, or for breaking news that could cause markets to panic and buy safe haven currencies, you will start to see trade opportunities almost daily as the headlines appear and prices react. To get a good feel for how this plays out, let's go to the feed and let's take a look at the kind of things that we could use as a possible trade opportunity to give you a good starting point. Okay, as you can see here, we are looking at, again, something in the feed. We're basically looking at one of the session forecasts. And basically, this is the easiest way to find the trades. What you're looking for are reasons to buy or sell certain things. So if we're looking at the current sentiment, this is basically the overnight news, what happened, what's been moving. Now, if we look here, we can see in this we've got a few reasons. First of all, about the pound. Now, yesterday, when this session forecast was being written, the pound sold off because UK retail sales printed a much worse figure than the market was expecting. So the pound sold off. However, at the time, the big picture was that the Bank of England had just been really, really hawkish, basically talking about hiking their interest rates fairly soon, and that the fundamental picture was that the pound should keep strengthening. So this short-term sell-off from the UK retail sales. Okay, testing. I think I just sat on it. Okay, again. Okay. Okay, so if we look at the feed here, basically what we're going to do is we're going to go through what you would look at, of course, at the beginning of each session. So you can either look for the opening news, or the most popular or the best way of doing it is to look for the London and the New York session forecasts, because these contain all the overnight news and the pre-session news and what's moving the markets, and then a little bit of analysis to help you find a trade. So in this one, what are we looking for? Well, you can see here the first part of the trade is here. Well, we look at the trade first of all. The trade called down here. We were buying dips on pound Aussie because of poor Chinese manufacturing data had continued the Aussie sell-off. And then, of course, we were looking to buy the pound because of the big picture. Now, the reason this is explained a little bit more in detail here. First of all, the day before, the UK retail sales came out worse. The pound sold off. You'd think that was negative. Well, it was in the moment, but the big picture, as you can see here, there's no change because the Bank of England are looking to tighten in the next few months. That means put their interest rates up. So basically, all that's happened is the pound is now a bit cheaper for those longer term traders to start buying it back. So as it says here, we're viewing the pound weakness as an opportunity to get a better price for longs as we remain bullish in sterling the short term or the medium term. So that's the first one. Then the next paragraph, the Aussie remained pressured after the Chinese manufacturing activity printed a low. And basically that impacted the Aussie dollar because they're big trading partners. So in the session, we could expect Aussie dollar to sell off while the pound traders will be looking for some bargains to come snapping back up. That's a fairly decent reason to go looking for a trade into the session. Now, if we go to the charts and take a look at how that played out, we find the pound Aussie pair. we can see we were looking to buy the pound Aussie pair from, on the 24th, you can see the 24th of July, we were looking to buy the pound Aussie pair, and remember the level that we highlighted was, if we look in here, from the 212 level basically, 212 to 211.75. So if we go back to the chart here, you can see I've marked it out. This is where the price was. The price had obviously rallied off the back of that Australian dollar sell-off. And then as the price pulled back, we were looking to combine those two things. We were looking to get the pound, the bargain hunters, combined with the Aussie bears selling the Aussie dollar off. And we were looking to buy the pound Aussie. It was a pretty solid trade. As you can see, it pulled back to a very nice confluence. We had the old highs here overlapping with the 00 level. And if we draw a Fibonacci tool on this move, you can see we also had the 38.2% there. So there's a really good confluence. The final technical analysis matched up perfectly. Indeed, price pulled back and then rallied and off it went. So you can see that's the first way you find a good day trade is to see what's been happening pre-session. What are the London traders or the New York traders, they're coming to the desks, what are they going to be reacting to? What's everyone going to be looking at in terms of finding a trade, basically? So that's the first thing. Now, the other thing is to try and find another reason in the feed to basically buy or sell a currency in the moment. Now you can see an example happened here is you can see euro dollar are taking a leg lower in the wake of lackluster French manufacturing PMI releases, while the pound dollar has broken its overnight range to the downside. So while the pound was pulling back, coming to our levels where we were going to buy it from, the euro has also taken a leg lower after bad data. That's the kind of thing that, as long as you're prepared for that, you can possibly trade. Now, the best way to prepare is by going through the daily session, the daily analysis briefings with your mentors, with the trading team, with the analysts, whoever's doing it. Myself sometimes will be there doing it, and basically looking for what could possibly be coming up and how we expect the markets to react. And that will give you a good preparation for what to look for and basically what to expect. And again, as we mentioned, there's no examples in this feed at the moment, but they're fairly rare, but when a central bank member or when something gets announced unexpectedly, that also gives you a fantastic reason to jump in mid-session. So you need to watch this feed, listen to the squawk, not only for the analysis at the beginning, which of course we will help you with here of your first few months, but on an ongoing way, you need to have a screen dedicated to this feed because this can provide literally easy pips that you can take advantage of through the session and find decent little day trades for. As you can see, day trading the newsfeed does not apply some of the technical concepts we've looked at through the course, but the main focus is on the fundamental reason for the trade, rather than where to specifically get in or get out. It's very important to understand that trading is not something that can be turned into a mechanical system or method that you do blindly over and over again, and rather something you will get better and better at over time by first of all applying the right concepts and then practicing and learning from each trade you take. There are literally unlimited ways you can identify a day trade, and we'll be looking at some examples of actual trades taken on real money to illustrate this at the end of the course. Another strategy that you can use is one that has an extremely high probability of success and is also extremely simple. The caveat is that it can only be used when there is an extreme deviation or surprise that the markets absolutely did not see coming. The easiest way to work out whether or not this has occurred is to simply research each risk event and find out what the market is expecting, so that if the opposite happens, you know it will cause a big sustained reaction. The key word here is sustained, because lots of minor deviations cause reactions, but these are very quickly retraced, and with a few hours, it's all back to normal and it's as if they never happened at all. Lots of new and retail traders get sucked into those moves and end up buying at the top or selling at the bottom only to watch the price move against them. An example of this is if a central bank announces a rate adjustment when the market was expecting no change. In these circumstances, it is hard to see a trade ever losing, but of course, these instances are also rare. Another example is if something really unexpected happens completely out of the blue. For example, if a central bank member was giving a speech and then said something totally unexpected and out of character. Again, we've used the example like a dove saying something hawkish and vice versa. This would also get the market moving in a sustained manner. This should not be used on small data points that have a deviation from the expected figure. because it's better to trade these type of things on pullbacks, and also we need the sentiment at the time of the release in the right order to get any kind of tradable move. So as long as the event is extremely unexpected and has some kind of direct impact on the market's expectations for the bank's monetary policy, then you're good to go. And the method of taking advantage of this is extremely simple. You just make sure that you enter the market either before or at the close of the first 5-minute candle after this event has taken place. Stops can be placed either the halfway point of the candle or just above or below it, away from your entry. Targets should be based on normal things like old highs or lows and average range of the pair, but you can also hold for longer if there's a solid fundamental picture supporting the move and the market has a clear expectation of where the price of the pair could get to go in the long run. The main point is that you should be getting it within 5 minutes of the initial event to ensure that you make some pips from it. This of course requires watching and listening to the news feeds like a hawk, but when you get a few trades like this each month, it will be worth it. As with all these strategies, look out for the analysts to point out any such setups during the daily analysis briefings so you can get a really clear picture of how to play them. Day trading is a very good way to find consistent trades that have high probability and that require smaller stops, but the downside is that you have to be sat at your trading desk all day to find them. This can get very tiring very quickly. So there are other day trading strategies that you can use to find opportunities days and sometimes weeks in advance. I'm talking about the concept of trading risk events. A risk event is basically any economic release or announcement that is scheduled on the calendar. Now, not all risk events are equal, and some do not move the market even 1 pip, while others have the entire trading world in utter anticipation for days on end leading up to them. This strategy again relies on understanding and knowing which risk events to trade, and this will come through experience, but you can shortcut this by following along with the daily analysis sessions that we hold with our senior traders and analysts here. In those sessions, one of the biggest points is to highlight the tradable risk events that you should be focusing on. You will also notice that a huge part of our newsfeed revolves around planning these risk events each day. We post the full risk events calendar at the start of each day, but also highlight the events that are most likely tradable in the upcoming session and write full trade plans for those events for everyone to use in their preparation. By following along with all of these things, you will shortcut your learning curve and find that risk events are an extremely solid way to make consistent pips with actually low risk. So what's the process for trading risk events? Well, first of all, there are 2 main ways to trade a risk event. The first is trading into a risk event, and secondly is trading out of a risk event. So let's look at trading into a risk event first of all. We trade into risk events because this is generally how the markets trade them. Many people imagine risk events to be chaotic carnage and visualize images of trading floors in utter panic with everyone running around trying to react to the number as it's released and huge amounts of money being made and lost. And on some trading floors this does happen, but only on huge and particular events such as the hotly anticipated NFP figure or a surprise interest rate move by a central bank. Generally, risk events are traded in a much more serene manner, with careful planning and pinpoint accuracy regarding entries and exits. So let's understand exactly how this works by looking at some examples of how they play out. First of all, traders will get the calendar and the expected forecasts for the following week on each Friday afternoon. This allows them to see what risk events are planned and, most importantly, how the economists and experts anticipate them to be released. Some show a better reading than last time and some show a worse reading and so on. They then use that information to tie in with the bigger picture. For example, if we're getting UK average earnings next Wednesday and it's expected to be much better than before, and we also know that the Bank of England have made average earnings one of their key focuses in deciding whether or not to hike their rate, it's likely that the market will start buying the pound into that event because it's expected positive, and this is expected to make the bank more likely to hike their rate sooner. So the big picture is very important when deciding to trade into a risk event, and the general rule is that we need the expectation to match the overall picture for that currency. So if the event is expected to come out better than previous, and the currency is bullish in the long term, this is a decent reason to trade into a risk event. If the event is expected negative or worse than previous, and the currency is bullish in the long run, then there is no real trade into the event and it should be left alone. Again, you can shortcut your learning curve by reading the central bank analysis that our analyst team post on a regular basis, and these reports cover the 8 major central banks to help give you a clear overall picture on what we expect. This is a very quick way to catch up on what is driving each currency and which way we expect them to be moving over the coming months based on the underlying fundamentals and central bank stance. Once you have the expectation and you know the big picture fundamentals, your next step is to try and find as many analyst reports as possible. Analysts are experts at putting all of the information together and creating different scenarios and trying to figure out the likelihood of something happening or not. They will write interesting articles on what to expect from the upcoming risk event and why they feel a particular outcome is likely. This gives you a final roundup of how the market is viewing the event overall. Once we have a risk event that we are confident to trade, the next step is actually entering the market. As with day trading the newsfeed, the important thing is not so much where you get in, but rather that you are in at some point between the market open for the week and the day of the risk event itself. If you are correct in your analysis, the markets will start moving in the expected direction in the run-up to the event, and you can actually take your profits before the event is even released. As a general rule, the closer to the release you enter the market, the fewer pips you should look to make. The goal of trading into risk events is that you should take your profits before the event is actually released so that you save yourself any of the risks associated with holding through a volatile news release. Of course, if you want to hold on for extra pips, that's fine, but if you're only getting on the morning of the release, on the day, then you may consider it wise to hold through the event. If you do that, then you should always have a day trading size stop in place, and if you do have a profit on the table, or if the price is closer to your target than it is to your entry, then of course you should never lose pips on that trade and you can manage it accordingly. If the risk event comes out as expected, you'll get a reaction in your direction. And if it comes out the opposite of what you and the rest of the market were expecting, which can happen, then the price will quickly reverse the entire move that have led up to it. So you at least want some small profits locked in or the stop at break even. Again, following the analysis sessions, trading reports that we post into the newsfeed, along with our own research and analysis, will drastically shortcut your learning curve. But ultimately, the quickest way to get good at trading risk events, of course, is by practice. So let's just quickly recap how to trade into a risk event. First, you need the forecasts to show something that matches the overall fundamental view for that currency, positive or negative. Next, you need to research and check what other analysts are saying to give yourself extra views and preparation. Finally, you need to get into position as early as possible at the best possible price, and technicals can help with this, but you could also use the position splitting technique we talked about earlier if you're really unsure about getting in at market or trying to wait for a possible pullback to a better price. As the trade plays out, look to exit at some point before the event so that you're not exposed to any more risk than you have to be. Sometimes there will be no clear expectations for a risk event that we can trade into, despite the fact that it is viewed as important and could still cause volatility. In this scenario, we keep a very close eye on it and try and trade out of it instead. This is generally a little safer because we know very quickly whether we are right or wrong, so we can use a day trading size stop to get us out in the event we've got it wrong. So how can we trade out of a risk event? Well, the process is very simple. We first of all highlight the events that could potentially impact the market. Then we do the same kind of research and determine how anticipated they are by the markets and the analysts. Then we identify a possible deviation from the expected figure that could really impact the price. For example, if an unemployment figure is expected to show a reading of 5.8%, then a reading of over 6% would probably be considered much worse and worth trading. Conversely, if a reading of 5.5% would be considered pretty good and worth trading in the opposite direction. Now, this doesn't mean that we want to just trade every risk event whenever there's a deviation. Instead, it's best to line up deviations with the overall fundamental picture. So, for example, we want to be waiting for an event just in case it has a positive deviation, because this lines up with the overall positive fundamentals that are driving the currency right now. The opposite is true for currencies with a negative view on them. We would be looking for negative deviations on the high impact event. Again, while you are learning, it will pay dividends to follow the senior analysts very closely in the daily analysis sessions as they walk through the plan for each risk event each day. And of course, the news feed, which will also contain detailed plans and research for every major event that you can use as a basis for your presentation. But the general rule of trading out of risk events is taking advantage of unexpected deviations from what the market is expecting. Of course, you cannot use or plan these because they are unexpected, but it's certainly worth being at your desk when the releases come out so that you're ready and can take advantage when it does occur. So let's spend a few minutes going through the process of researching and preparing for risk events and then determining how we can trade them either in or out so that within a few months this can become an almost unconscious natural routine that you follow every week. Okay, so let's look at the calendar here. And basically this is your routine every week. The week before I do my research, and most of the traders do their research on each Friday when all the forecasts are released. Now what we're looking for, we're going to first of all talk about trading into a risk event, and it just so happens that basically I had taken a risk event, or I trade into a risk event as I was recording these videos. So we're going to go through that example because it makes sense. So as you can see, we're looking at Tuesday the 28th of July 2015. GDP for the UK is expected to come out, second quarter GDP. The quarter-on-quarter reading was previously 0.4%. And the expectation, this is a weekly calendar I've looked at to try and get it, but the expectation was for it to come out at 0.7%, okay? So what I was looking for is this. It's expected to come out much better than previous, and if we look at the feed, we can see that the overall fundamentals on the pound, if we go to the one of the session forecasts, which we can do right now, you'll see that basically the overall fundamental picture for the pound, and we'll go through it because it's worth doing, was basically very bullish, and we were looking for strength on the pound. So if we go to the fundamentals here, you can see that overall we were looking at recent comments. You can see here recent hawkish comments in the recent past from Mark Carney and the other MPC members. So basically we're in an environment where everyone's bullish on the pound. They were talking about hiking rates. It was all very positive. There's no reasons to sell the pound. Now, on top of that, we come to the calendar, we have a GDP reading which was expected, I know it doesn't say it here, but it was expected to come out much better than the previous of 0.4%. So it's expected to come out at 0.7, okay? So we've got a combination of a currency that's really bullish, a risk event that's really positive, and it's a big one, it's GDP. This is something we can trade into. So I did that. And you can see I entered the trade. That was on, that risk event was coming out on Tuesday, the 28th of July. I entered a trade on the pound yen. Here you can see it on Monday, the 27th, as the markets opened. I got into my position early and I just rode it basically. I rode it out, and as the price spiked up here, the risk event came, I actually traded through the risk event. So it actually came out in line at 0.7. So now we had a situation where the big picture fundamentals were really, really good. Everyone's going to buy the pound. Everyone's thinking they're going to hike rates soon. The GDP figure came out as expected, so there's even less reasons for anyone to be nervous. There's absolutely no reason now why anyone is going to sell the pound in this moment, so I just held through it for an extra 100 pips, and you can see I took it off right at the top there, which is where the price currently is. So it's a very handy example. It's a very convenient trade that I took, considering I was recording these videos at the time. And that was basically, you can see, a trade into a risk event. Now let's have a quick look at trading out of risk events. Now, the process for trading out of risk events is a little bit different because basically what you're doing is you come into the feeds, and what you're going to do is you're going to first of all look at the calendar, you're going to see what's coming up, and you're going to see something that could be interesting. So for example, on this weekly calendar, there's something quite interesting. And again, it's very hard to do it because unless you actually get an example happening. But we want to look for reasons why the market might trade a particular risk event and might react to a particular risk event, basically, which is going to cause the markets to sell it off or react in some way. So, as you can see here, we've got the European CPI estimates. This is inflation, and of course, in 2015, the ECB were conducting a QE program, so inflation was one of their big trigger points. And you can see here that we were looking for the expected figure to be in line with the previous, which is 0.2, which isn't really showing much of an improvement. And considering the program's only a few months old, we're looking for the market to get that in line. And what we're looking for here is we're not looking to trade into it, we're looking for the deviation. So what we want is a CPI of less than 0.2. We want a CPI of 0.1. You can see the low expectation is 0.1 here. We want to see a CPI of 0.1 or less, okay? Now, of course, very often it doesn't happen like that, but we're looking for a very specific thing. We're looking for a deviation. And we can say on this one, because of the big picture fundamentals on the euro, we're only interested in the risk events that deviate negatively, okay? So if it comes out positive, if it comes out 0.3 or higher, we're not interested, basically. We're only interested in those negative deviations because, why is that? Because the big picture fundamentals on the euro are clearly negative and bearish. So what we would do is we would check the risk event report as they're due to come out, we'd read it, we'd do all our research, and basically all we'd do is we'd find the best pair to trade, so for example euro pound or euro dollar, whichever one it would be. Euro pound obviously because in that week, because obviously we're looking to buy the pound. And you can see here, we would simply look for some decent levels, and if that risk event came out negative, you can literally then just jump in. You've got two options. Because it's so in line with the big picture, you either jump in at market or you can wait for a rally, or of course you can split your position to get into the market. So you split your position in half. So if you do jump in and it makes pips, you make a little bit less, but you make something. And if it does pull back and you're getting on this one, there's a little bit more risk associated with it, but you still end up making nice pips if the price eventually runs to your ultimate target. So again, that's the differences. One of them, you want to trade in if the risk event is expected to match the overall fundamental picture, or if it's not, if it's got no expectation like that, we want to sit there, stalk it, and make sure we're waiting for the right one. So for example, in that one, we're waiting for a negative deviation. We might not get it, sometimes, most times we never do, but we want to make sure we're watching that risk event so that if we do get it, because the ECB are so focused on CPI, that's what makes it important. You don't just do this for every risk event, you only do it for the ones the banks are focused on or the market's focused on, and that of course will come from your daily session briefings and analysis. Pick those out, look for the deviation to match with the fundamentals, and then of course trade away. And that's basically, in a nutshell, how you trade into and out of risk events. And of course, you'll see this happen over and over again, day in, day out, as you attend those daily analysis briefings. So now we have a collection of short-term strategies. The next thing to do is start zooming out a little bit and look at ways to trade the markets without being tied to your desk, if that's the path you wish to go. It's worth having a good understanding of how to trade in this way for when you eventually manage a much larger fund that requires more careful trade management. Now, what we're going to look at here is the first one, which of course is trading medium-term sentiment. This basically means any reason we could have to hold a position over a period of 1 to a few weeks. Now, a classic example is when we have an upcoming event that the market is getting excited about. For instance, imagine that there's been an article written by a respected Fed watcher that indicates that the Fed may be about to cut interest rates at the next meeting. And the reasoning given makes sense and matches up with the recent data pretty well. It all lines up. If the market's taking this seriously, it will very quickly appear as a headline on most of the major news feeds and gain traction as a market-moving story. What will tend to happen is that the currency will move in line with the rumour right up until the next Fed meeting, as specified in the article. This is just a simple, small example, and there are many other things that can sway short-term and medium-term sentiment. It can be anything from a global financial crisis or military conflict between major nations causing safe haven flows to something like a set of data causing economists to downgrade their assessment of an economy and calling for the central bank to act. The point is that we have some very solid reason that the market is also paying attention to. Because remember, to make money, we need the price to move after we have entered. And this requires the rest of the markets being on board with that trade. A good way to get trade ideas for medium-term sentiment is by following the feed and looking out for the trade alerts from major investment banks, brokers or analysts, because they almost always trade medium-term sentiment. This type of trading allows plenty of time for analysis and entry, but does require larger stop losses than for day trading, usually about 100% of the average daily range or even sometimes more. But for the same time, it can be much less stressful way of trading and stop you getting sucked into the intraday noise associated with scalping or short-term trading. Trading medium-term moves requires huge discipline because if you're going to be sat at your desk anyway, then this may get in the way of you objectively monitoring the overall picture and impact your performance. So it's worth thinking this through before trying to integrate it into your regular trading. As you've probably guessed, this type of strategy does not require too much technical analysis for your entry, stops and targets, and these can all be based on bigger picture things that we'll look at next. We'll go through an example of how to research and identify these types of trades, and again, practice will be your best friend here, and you should make it a big point to learn from every trade so that you do not make the same mistakes twice. Okay, so as you can see, we're on the feed, and the best way to stay tuned in and get ideas for medium-term sentiment is just to follow the analysts and investment banks. That's the simplest way. And one of the easiest ways that this happens on the news feed is by just literally following the trade alerts. So let's have a look here. If we click the filter trade alerts, you can see here that we have, there we go, the trade alerts pop up. Now what we're going to do is we're just going to pick one of these. You can see City Index was a broker. They entered a new trade buying the pound dollar, and you can see the trade was to buy the pound dollar, enter at 156.20, put the stop loss at 154 and target 158.90. Now you don't just trade this blindly. What you would do is you're mostly paying attention to all this down here. Why are City Index buying the pound dollar? Why are they doing that? What's their rationale? Is it a good fundamental reason? Do they seem like they're tuned in with the sentiment, or have they missed something completely massive that really puts you off the trade? And that does happen. Investment banks, they're not necessarily the wizards of the market. They don't necessarily get it right all the time. They're just people at the end of the day. So you need to match their analysis with your analysis to make sure everything makes sense. So in this trade, we're buying the pound dollar from 156.20 on the 14th. And you can see the 14th was around about here. As the market kicked off, and basically 156.20 was just above this level here, and the stop loss was down here at 154. Now as you can see, as this trade's playing out, it's playing out literally over about 2 weeks and probably longer. This is a medium-term sentiment. This is going to give you plenty of time to get in. It's going to give you plenty of time to absorb the trade, plenty of time to catch the move. Now of course, if you see the bank has entered at 156.20, and they've got their stop loss down at 154, and the price is down at 155, that gives you a better price to enter. Nothing's changed. It's a medium-term trade. As long as they're rationale, you can read this for yourself. What's the reasons? As long as that hasn't changed, nothing significant has happened, you can actually use this as a prime opportunity to get into a really good trade at a much better price in line with a major investment bank or broker. And in reality, if you're trading medium-term sentiment, the simplest way to do it is to follow along with the investment banks and the analysts, because our trading team posts trade alerts in here as well, of course, and basically this will allow you to get very quickly up to speed with how the medium-term sentiment is. So you will follow the reasons, you'll read them, you'll see the trades, and over a period of weeks and months, you'll start spotting trades of your own, you'll start thinking in the same way, and your rationale will be virtually identical to the trades placed by those banks. So again, we keep it very, very simple. There's not much, not much complexity behind it. It's all about following along, seeing the reasons, seeing the trades playing out, and then trying to improve on that by making it better with your own practice and your own experience. There are other reasons to trade slightly longer term, and one of them is for the carry interest that you'll receive on holding a certain currency pair in a certain direction. Carry trading is a very interesting proposition because it gives two incomes from one position in the market. The first is the interest paid to you for holding the position, and the second is the capital appreciation you get from when the market moves in your favour. We're not going to explain the ins and outs of interest payments here because this should be something you'll research independently using the tools we've provided. But in a nutshell, if you buy a currency with a high interest rate and sell a currency with a low interest rate, then you will pocket the difference. Of course, the opposite is true. If you sell a higher rate currency instead of buying it, then you will actually have to pay the difference each day. To simplify it further, imagine that you took a loan from the bank that charges you a really low interest rate and then deposited that money into a bank with a really high interest rate. The difference is what you can keep as profit. Now, the other great thing about carry trading is that lots of other traders have the same idea. So if you can get in at the right time, it's almost a guaranteed trade as the price moves in your favour with each new trader loading into position. Carry trades should be approached over a period of months, and it's also worth splitting your position into 3 or even 5 pieces and planning your entries based on where the price may go over those coming weeks or months. Splitting positions will take the pressure off trying to pinpoint an entry. Currency prices can be volatile, so instead of viewing these price swings with dread, you need to train your brain to view them as exciting opportunities. So you can get in at market, receive some interest, and also plan where you will get in again if the price moves either in your favour or against you in the short term. Exiting a carry trade can be the trickiest part because when does the move end? The reality is that carry trades can literally play out over years until something major shifts in the underlying fundamentals and causes a sharp unwind of those positions. Traders hate pain and loss, so anything they consider to be a concern, they will react to. However, these episodes can also be viewed as an opportunity because traders almost always overreact to good news and bad news alike. So when you see the price hit all-time highs, be cautious. And when you see price plummeting, despite nothing really major changing fundamentally, you should be planning on how to take advantage of this opportunity and get in at a better price. Generally, splitting your trade over the course of a quarter or even a year can be a good way to plan and time your entries and exits. There's nothing wrong with planning your year around a single trade and waiting patiently for the price to give you the opportunities to build your position. This is strictly position trading and is virtually impossible to conduct if you're also day trading at the same time. The here and now goings on in the market will just be too much of a distraction. If you are a day trader and do want to carry trade also, then simply do it on a totally separate account that you do not even open during the day. So let's take a look at how the price can move during a carry trade and how you can plan your positions to take advantage of these moves. Okay. What we're going to do is we're going to look at an example of a classic carry trade, one of the most famous carry trades in recent years, and it was on the pound versus the Japanese yen. Now, it lasted from roughly the beginning of the year 2000 all the way through to the global financial crisis, and if that crisis hadn't have happened, it very likely would have been carrying on. So you can see here the period, we've marked it in between these two markers. The pair just trended up and up and up and up and up. This is of course a monthly chart. And this happened over a period of 6 or 7 years solid. Now, the global financial crisis, of course, reversed the entire move, but that was a completely separate issue. So let's look at what caused this move up. At the time, the UK had interest rates which were well above 0%. They were around their average peak, or about 5 or 6% over the course of this period of time. At the same time, the Bank of Japan had kept their interest rates basically at 0 or virtually 0 because they'd been going through decades, almost 20 years or at least 15 years at that point, of crippling deflation. So the prices in Japan were getting lower, inflation was always in negative territory or at least around 0. It was a bad situation. So to try and combat that, the rate was virtually always at 0. It was never had any hope of ever going up as long as that crippling deflationary situation was playing out in Japan. Well, meanwhile in the UK, the economy was looking much better, interest rates were much higher, and never really went much below 4%. So because of that, the carry trade stayed popular for as long as the interest rate differential remained. So as long as that difference of 5 or 6% remained, that was a fantastic yield for pension funds and large institutions to just hold the pound yen. And also the capital appreciation, which you can see at its peak, went over 9,000 pips over a 6-year period, which is of course an absolutely fantastic return. So basically, this whole carry trade is a classic example of the perfect storm that lines up when you get two central banks going in opposite directions in the big overall fundamental picture. And traders holding the pound yen could have basically gotten in at any point over that 6 or 7 year period and made both profits on the capital appreciation and profits on the carry. And if you're holding over a period of 5 or 6 years, if you think about 5 or 6% per year, on top of the 9,000 pip capital appreciation, you're looking at a pretty, if you got, depending on where you got in, doubling your money and then making, an extra 30, 40, 50% on top of that with the carry interest. So very, very attractive trading. And for what? No real trade management. All you've got to do is keep your eye on the big picture, make sure those two central banks are going in opposite directions, and hold your nerve. And that's basically how carry trades play out. Now, you'll also notice there's some fairly big swings. You can see the price moved, it looks nice and pretty on the chart, but you'll see the price moved, 1,200 pips, 2,000 pips sometimes back against the trend. But as long as those fundamentals remained in play, the overall trend remained in place. So, despite the pullbacks and the drawdowns and the safe haven flows and all the noise, this is why you can't be day trading sat at your desk if you're a long-term carry trader, because you have to literally plan and also implement discipline. If you're watching the price every day, you're going to find it impossible to hold through these drawdowns. And if you're going to use leverage, well, you're basically committing trading suicide, because these big pullbacks would literally wipe out your account. So you absolutely can't use leverage. In fact, use negative leverage, but the percentage returns you're making and the carry interest more than make up for that, and actually make for a very, very interesting trading strategy if that's something you're looking at, and particularly if your plan is to manage large funds like pension funds or hedge funds at some point in the future. Carry trading leads us nicely into our final strategy, which is trading pullbacks against the underlying fundamentals. Trading fundamental pullbacks is probably the simplest strategy of all, and basically involves patiently waiting for the short or medium term sentiment to change the flow of the price away from the overall fundamental trend. A classic example of this can be taken from the example we used earlier in the 2013 Bank of Japan decision to launch their quantitative easing program. This set in motion a severe weakening of the Japanese yen as the bank printed billions of dollars worth of Japanese yen every month in an attempt to get inflation up to its target range. At the same time, the Federal Reserve in the US were just about to cease their own QE program and start the long march towards putting interest rates up. This gave the perfect divergence between two central banks, both moving in completely opposite directions with their monetary policies. When this happens, there is only one way the dollar-yen currency pair is going, as traders buy dollars and sell Japanese yen. However, it's not as simple as the pair moving up every single day and everyone getting rich. There are short-term events that will make the pair dump, sometimes quite heavily. Let's look at one example of this and how it affected the pair during this time. At the beginning of 2014, we had a crisis in emerging markets as traders started panicking about the fact that the Fed were ending its flow of cheap money via QE. They reasoned that this meant emerging markets would suffer as the investment from that cheap money would dry up. The market went into a chaotic freefall and everyone headed for the traditional safety of, you've guessed it, the Japanese yen. So despite overall fundamentals being in place, the short-term move saw the dollar-yen pair absolutely dump almost 1,000 pips as everyone brought Japanese yen as a temporary safe haven. Many traders also panicked out of their long-term fundamental positions, but other traders had been waiting for this type of event. The reason is that they now had a fantastically cheap price at which to enter the trade and ride up the move as markets calmed down and regained their rational thinking. This type of trading requires patience and focused research, but can yield fantastic returns if you can keep a cool head when the rest of the market gets sucked into some temporary story that will not last longer than a few weeks. If you're already in a long-term fundamental position, have your stops in place because you never know how far the market will move against you. Not many people can stomach 10 or 15 or even 20% drawdowns, especially if they're managing client accounts. But at the same time, plan ahead. Where will you re-enter? Perhaps having 3 distinct prices that you will use to get back in. Generally, if you're waiting for these type of pullbacks, then we don't recommend entering anywhere near around the high or the top of the average range from the most extreme high, or twice the average range from the top of those extreme highs or lows. The yen pairs are of course more volatile than most because of the safe haven element, but these types of pullbacks will happen across the board for reasons as simple as trading exiting their trades and taking profits. So, the best way to approach this is to be doing your daily research as normal and then relating this to where the price of the various pairs have been trading over recent days or weeks. You will naturally notice that some pairs are just not where they should be or are trading in completely the wrong direction based on the policies of the two central banks. When you see this, it's time to zoom in on the pair and find out exactly why it's been moving the way it has, using all the research and news feeds that we provide. If it's due to some temporary event, then you can consider this an opportunity to enter. Again, splitting your position into 2 or 3 may help you get to grips with this at the start, and this is also a perfectly valid method for your trading as a whole. The question you should be asking when investigating an opportunity is this: when this short-term thing is over, will the original fundamental divergence between the two central banks still be in place? If the answer is yes, then you need to start planning your entry and identify the best time to start getting involved in the market. There is no perfect time because anything can happen at any time, which is why we go to great pains to make risk management part of everything we do, not just how much we risk. This way, whatever happens, we are protected. So let's take a look now at an example of researching, identifying and managing a trade based on pullbacks against that fundamental trend. Okay, as we look at the chart here, we are looking at the dollar-yen pair because that's the pair we just went through. We've used this example quite a few times because it's a perfect example of really major extreme central bank divergence. Now, the bit I've highlighted here is the moment when the Bank of Japan announced their QE program. Now, you'll notice, if we just take a bit of a view here, you'll notice the price rallied and rallied and rallied and it all looks very pretty. But if we look at this in the short term, look at the opportunities that the long-term fundamental traders had to get back in. So as the price boomed up here, or even rallied up to here, you can see, as we looked at earlier, the moving averages give us a good clue. The average price was around about here. The extreme high was way above where the average price is if the trend had played out in a nice kind of civilized fashion. Whereas in reality, the market got overexcited and it boomed and it got a little bit too carried away. So the fundamental traders, or if you're trading the long-term fundamentals, you're not going to be buying up here. You're going to be waiting some point in between these moving averages, at this somewhere around in the midpoint between the 50 and the 200. As the price pulls back down, again, that doesn't mean you just buy, but it means you now start feeling much more comfortable where the price is and then look for opportunities to buy back in, whether that's a change in short-term sentiment, whether it's a technical level, or whether it's just positioning yourself with the long term in mind and using larger stops. Whatever it is, you then get back in and then ride it back up, and there's lots of pips to be made. You can either hold, of course, for the 110 target, which of course was the Bank of Japan's initial target, or you can take your profits, based on either 1 or twice or 3 times the size of your initial risk, and just have a simple strategy like that. But notice how many times the dollar-yen rebounded back towards its average price, making it a good opportunity to trade again. Notice several times it rallied way above it. At those points, you don't get carried away, you don't get sucked in. And then as the price came back to its average price, this is now, and it sat there, you can see in 2014, it sat there basically for pretty much the whole first half of the year, right in its average price. All this means is that basically this is any point here, any one of those 6 or 7 months, long-term fundamental traders will be comfortable looking for opportunities to get back in and ride the fundamental trade with that move, basically, okay? And again, don't overuse the moving averages. This is just a guide, as we said in the technical section, to give you a rough guide of where the price is. And again, price then rallied up. Do you get overexcited and jump in? No, you wait for the price to pull back. And then again, the price rallies again. And again, you don't get too excited. You wait for those pullbacks and you keep getting those rallies. Now, even at the time of recording this video, you can see it's been about over 2 years since the Bank of Japan instigated that policy. It's still going. So that means the dollar-yen still has legs possibly to go higher. We don't know how far it could get. The next target's maybe 127. But as the Bank of Japan, if that increases its QE program, it could even get to 130. At some point, the Bank of Japan will start to taper and reduce its QE program, at which point the dollar-yen, of course, will start to go the other way and trend in the opposite direction. But until those central bank policies change, remember, the trend is intact. So you need to keep your eye on the long-term fundamentals and then look at the price for good opportunities as it pulls back. Don't be fearing this. If you were long in here and the price pulls back and you get stopped out, don't be annoyed. Be viewing it as a fantastic opportunity to get even a better price, and you'll make more when it eventually rallies on the next kick. So that's a nice illustration of trading fundamental pullbacks in line with that overall big picture trend. If you are day trading, then you will naturally see these opportunities too. So please do not feel that you should only be trading a specific strategy or system. Remember, trading is about finding opportunities. If you found gold in your garden, you wouldn't leave it in the ground because selling gold is not your normal method of making money. You would seize the opportunity and make extra money. The same is going to be true of your career as a trader. Your job is to see opportunities to make money, and everything you have learned here will help you spot these opportunities, and as you trade and practice these skills, the amount of money you make will gradually increase over time. So to conclude this section, you now understand the process you need to go through before looking for a trade. You have some strategies that you can look for immediately and start applying on your practice account. We've also prepared some recordings of trade examples that I myself have taken in the past to illustrate how to approach this type of trading. And on top of this, we've also put together some recordings of the daily analysis sessions which have been shortened so that you can see the process is something we have used over a period of years and will not change in years to come. Finally, there will be a selection of printouts and cheat sheets that you should have on your desk at all times to help you stick to the processes we've discussed in this course. Before we close this section out, it's vital to remind you that you should keep referring to this course over the first few weeks of your trading, while also talking to your mentors, following along with the daily analysis sessions and researching the markets thoroughly using the tools we've given you. Remember that each trade you take is a mini lesson in itself, and you should use the trade review handouts to keep a log of your progress so you can spot your errors and your progress and continually work on any weaknesses that you have. So gather your printouts and worksheets, get everything ready, rehearse your daily process, and then start trading your practice account until you start to see consistency forming and your results becoming positive. And I look forward very much to having you as part of our main trading team one day and working with you personally.